they've created something, they've made the new thing that's going to change the world. When you're going for investment raise, the numbers have got to stack up with the story. Otherwise, it's not going to make sense, and then you lose credibility.
Hi everyone, I am today joined by Martin Dean, Chartered Accountant and Corporate Finance Expert with over 50 million in career deal value.
Yeah, it's probably more than that now, to be fair.
More than that, and still to keep growing. So you've been doing this for over 10 years. So what we're doing in this video is a format where we have an expert and very much a non-expert, and we're going to talk about one of the biggest issues that we think businesses are facing right now, which is basically it's getting really, really hard to acquire funding, whether that's through lending or external investment. So the first question really is, if you're a small medium business owner, why is it so much harder to raise funds than it used to be?
I think it boils down to sort of economic uncertainty. You know, we've had COVID, then tariffs, then wars, and you know how that impacts the lending market is there's still the money there, but it's just harder to obtain because you've got to answer all these questions. How's your business robust enough to sort of cover these areas? What if tariffs come in? What if another COVID happens? What if there's a war in a country? Where's your supply chain limited? How does that? So there's just so many more questions to ask. It's all that uncertainty. So it's not that the money's not there. A lot of the time, there's probably money there to deploy. It's just you've got to cover a lot more bases to get an investor or a debt funder more confident that you know their money is saved or investable. Really.
So it's primarily a greater amount of risk or perceived risk is why the investors are more cautious now.
Yeah, absolutely. Yeah. So, you know, and how sort of investors and lenders will look at that is, you know, interest rates will go up to cover that risk. It's got to be worth their while. Generally speaking, debt funders will look backwards. So they get comfort from looking backwards at historics because essentially they look at historic performance. Okay, can this company afford the lend that we're going to put into the business? And the interest rate is the risk that they're taking for that. Whereas equity funders, they tend to look forwards, so they want to see growth. I think with any sort of fundraise, you know, looking at who the stakeholders involved, what type of raise are we creating, or what type of lending are we after? They're going to want different things, and you need to think differently. You have to put yourself in their shoes and think, well, what's important to them, and what do I need to cover?
So it's not a case. So if you're a founder, it's not a case of the funding isn't actually available. It just means that they need to approach it differently.
Yeah. You've just got to have, you know, most of the time, especially with founders, if you're going for an equity raise, you know, most you know startup equity sort of play businesses, they can tell the story. They've created something. They've made the new thing that's going to change the world. So they're very good at telling the story. But when it comes to the numbers, it doesn't convert. And that's the key. When you're going for investment raise, the numbers have got to stack up with the story. Otherwise, it's not going to make sense, and then you lose credibility. Then you're either going to get less favourable terms or no terms at all. So that's why it's quite important. The numbers and the storytelling need to be together and aligned.
So if you're approaching a funding round, how do you sort of reconcile the numbers with the story that you're trying to tell?
Yeah, well, essentially, you know, you look at the story, and I suppose part of our role and what business owners should be doing is put yourself in the other person's shoes. Well, does that make sense? You know, and also ask those questions of yourself. You know, there's so much technology out there now. You can lean on advisors. You can lean on, do the Q&A process. You know, critically appraise your own story, your own assumptions, your own numbers. And I don't think a lot of business owners do that. They sort of have the story, they focus on that, but they don't look back and think, does this make sense? So I think that'd be the tip that I'd say to founders in particular.
And forecast and financial model, these are the tools that you can use to do that.
Absolutely, yeah. I think financial model is, and now look, with the technology that's out there at the minute, it's a lot easier to sort of build financial models. There are some sort of foundations there where you need to be doing X, Y, and Z as a bare minimum to again tick that credibility box. But yeah, forecast financial model absolutely key to any sort of fundraise or looking for sort of debt funding.
So just for the non-experts in the room and watching, what actually is a financial model?
So a financial model is looking at the business and pulling together some assumptions that drive the future sort of financial sort of results of the business. So, anyone can sort of pull together a forecast, but really how a financial model differs is that it can flex quite easily. So, you change debtor days, creditor days, you change terms, you change the way certain adjustments, then the whole model flexes, and it becomes very easy to sort of put contingencies in or stretch it and sensitize the numbers and say what if. So I would say, like, a financial model now, yes, you've got to build the basis of a financial model and forecast, but I would say the sensitivity is just as important. So really sense check the numbers that you're putting in and do some what ifs. What if the margin drops by 2%? What's the impact to cash in 3 years' time? That's how a financial model is, very much future led, and how does this impact the business.
I see. And that's how you preempt some of these investor or funder concerns about things like supply chain disruption, more wars, more tariffs.
Absolutely,
or
yeah.
like that.
Yeah,
you can actually show them what would happen if that happens.
Yeah, so if I had to say what the main key aspect of any financial model or forecast is, the assumptions. It's the assumptions page. Build an assumptions page. Even if you're using a SaaS product, you still need an assumptions page to show an investor what's driving the numbers, and especially the cash flow assumptions that are in there. So again, it's become a lot easier now to do financial models. It's a lot easier to flex certain things. So if I had to say one main thing, is get that assumptions page right, put in the basics, but then think about your business. Think, actually, what are other drivers? What are other things I need to include in my assumptions that allow the numbers to flow forward?
And does the type of funding that you're trying to get, whether it's a bank, venture capital, private equity, or whatever, does the type of funding actually change what the forecasting financial model needs to look like?
Yeah, I think we've touched on it, previously. So debt funders they don't place reliance on financial forecasts generally. Whatever they're willing to lend is normally based on historic performance. You do get some lenders that will look at future performance and say that they will lend X based on that. But generally speaking, they look backwards, and their debt raise is based on that. So they get comfort that way. So the forecast in that aspect is just giving them comfort and credibility that their money's safe and that you know what you're doing and you have a plan. Because I think that's the key thing. It just shows that you've got a plan. Whereas an equity funder, they want to see forecasts going upwards.
Yeah.
They want to focus on growth. So again, anyone can do that, but the story that you tell along with that growth has to make sense for them to believe in what your plan is, really.
So where do forecasts typically fall short of the standard that lenders and investors are expecting then? What would you say are the big red flags that make them lose confidence?
I think two, and we touched on it, so I've stressed the importance of the assumptions page. I think not having that and really thinking about the assumptions that drive your business and what's sensitive to those assumptions, I think that's quite key. So assumptions page, that ability to explain the profit to cash. How does profit convert to cash, and why doesn't profit convert to cash? Why, that explanation between profit and cash in terms of the financial model is really key. You need to be able to explain that. So assumptions, ability to explain profit to cash, but also sensitivity. I think nowadays you need to be running sensitivity on every forecast and financial model that you do. So, and that, again, it's become a lot easier to do that with sort of AI tech that's out there. So yeah.
So I guess it's really important because it shows the investor that that thing that you're worried about, we're also thinking about that and we've considered it. And we're factoring it into our plans.
Yeah, ultimately, they are, a lot of business owners will look at it and think, well, they should be giving us money. But at the end of the day, if it's a big check size, they're wanting to know their money is either A, secure if you're a debt funder, or B, it's going to grow and you're going to sort of stick to the plans that you had in place. So there needs to be a realization they are stakeholders in the business and they're there to help, whether it's to support business through debt funding or to help it grow through equity and grow quickly. So yeah, it is a partnership. So you need to put yourself in their shoes.
So a lot of people who think about forecasts, they'll often put quite a lot of emphasis on profitability, but that's not actually necessarily the most important bit, is it?
Again, it depends on who, what type of investor and what type of funding that you're after, I'd say. But I think profitability is fine, but you've got to be able to explain cash flow and cash returns as well. So again, it goes to that point of you could have a really profitable business but cash flow is terrible because maybe it takes a long time to get your cash in from customers, etc. So you've got to be able to explain that story, because that's going to affect a lot of things. Covenant testing, if you're looking to raise some debt finance, you've got to put that in place so that the stakeholder, whoever that might be, that's investing in the business, is aware that there are certain issues and what needs to change to remedy those situations.
Okay, so for any founders or business owners who are looking into this, and what in your opinion does a good forecast look like? I know you've mentioned some of these things already, but if you could break it down into little chunks.
Yeah, I'd say the best forecasts or financial models, first page is assumption page. Definitely get that assumptions page in there. What's driving the financial model? Be very, very clear in the format. So have your profit and loss assumptions, have your cash flow assumptions. So I think that's the first key bit of any forecast. Start with that so someone can look at it and think, actually, I know what's going on. I think the second thing is that storytelling piece. So have a year 1, year 2, year 3, year 4 storytelling exercise. So this is what we're anticipating. This is our plan for year 1, year 2, year 3. This is the impact. Cash is tight into year 2 because we're having to invest in X, Y, and Z. So the storytelling matches the numbers that are in that financial model. I think that's quite key. And then the third one, sensitivity. So then sensitize the numbers. So look at your numbers and think, actually, what's quite sensitive here in terms of, so certain aspects might be more sensitive than others. So your gross profit might be really sensitive. So then what that means is you've got to make sure that gross profit margin is sort of tightly controlled, because a drop in that is going to impact the numbers, whereas something else might not be as sensitive. So it focuses your attention on the key metrics that determine the outputs of that financial model.
And should every forecast, and if you're looking at various scenarios, should every forecast look at the base case, best and worst case scenario?
I think so, yeah. Again, it's part of sensitivity, but if you've got 3 versions and you can clearly sort of demonstrate what each version means, like you say, I'd say mid case is your standard case. This is what we think is realistic.
That's if is that arguably the most likely trajectory?
Yeah, it's probably the most realistic. But then do a worst case, particularly if you're a debt funder. That's what they're interested in. Well, what if things go wrong? Is our money safe?
What's going to prevent them from paying us back?
Yeah. So if you do a worst case and it's still hitting the right sort of covenant levels, and your cash is still at a level where it's reasonable, and your debt service is at a level that's reasonable, all of a sudden they're getting comfort that, well, that's your worst case, so that's fine. And then a best case is, right, if it goes X, Y, and Z, this is what the outcome could be. And that gives you different options. If you hit those best case scenarios, you might be refinancing an early opportunity, you might be doing X, Y, and Z things. So it allows you to plan different things.
I imagine it's very important to be honest with yourself when plotting out these
best
and worst case scenarios.
Well, ultimately, whatever lender or investor you get, they're going to make you accountable. So whatever you put in that forecast, you're going to have to deliver, and they're going to ask questions if you don't. And again, it puts yourself in their shoes. They might be writing quite a big check to the business to put in the money. You've got a responsibility to make sure you stick to those plans. And I say most lenders, if debt or equity, they're not necessarily, they want you to succeed, and they're there to try and help. I think a lot of the time there's a bad rep of, they're there, oh, it's my business, they're just giving. But ultimately, they're there trying and help you succeed in the plans that you've got in place. So I just think forecasters, every business should be doing it and having one in place, because it sets your plan out what we think is going to happen over the next 2-3 years.
I was going to say, presumably there's a lot of benefit to a good, robust forecast and financial model outside of fundraising as well, just in terms of business strategy.
Yeah, absolutely. I think it's critical, really. We think internally, we're constantly looking at our internal forecasts. Are we hitting plans? Are we doing X, Y, and Z? I mean, that's we're looking 10 years away. But again, it's that forward thinking of where do we need to be and what hurdles do we need to hit at certain points, all of a sudden it makes you look at it and think, actually, we need to make sure we do X, Y, and Z. Otherwise, we're not going to hit these numbers that we set out as targets. So I think it's critical.
But a good scenario plan will also mean you're better prepared for the next COVID or the next war or the next big financial shock that could be potentially damaging.
Yeah, I mean, it's just my view. I think, I think business owners should be holding on to probably more cash than what they have traditionally. I think a lot of businesses used to run at a level where, it was always bad to have too much cash, and the premise behind that is, well, it's just dead cash that's sitting there. I would say, well, it depends how you are, depends how your business is, and how sensitive you are to economic changes. If you are, then really you need to be keeping a bit more of a buffer of cash in your business to allow you to sort of do well during those times, and it just puts you ahead against competitors. If you're in a position where something happens economically, your competitors are probably going to suffer. Well, you're not, because you planned for it. So if you put a model in place, then you're going to be ahead of your competitors when that happens. So, yeah.
Okay. Is it ever a good idea for a founder to DIY their forecasts?
My view is, yeah. I think they should, because it shows that they're trying to they've got a story in their head and they're trying to put it in number forms. What I would say it goes wrong is where they don't get somebody in at the right point to sense check it. If you're going for investment, for example, you've probably got one chance. You've got 30 seconds of someone's time to convince them. So I would always say it's really important that founders are educated themselves to a level, but realize it's not their expertise. They might need help to come in and for someone to say, actually, that's not quite right. Why have you done that? You're going to fail at this point because you've not explained that very well. So I would say yes. I would always say anything, like any sort of business owner, a good level of understanding of the numbers is absolutely critical. But where it's appropriate, lean on experts that do this day in, day out, and you've got more chance of success of getting that raise, I say.
And how would you find one of the experts who does this? Because it's not something that every accountant will do, is it?
I think the world's changing. I've always been a big advocate of forward-thinking stuff. So, management accounts with forecasts in place. Yes, you can monitor historic stuff, but really, we're more interested in what we think we're going to do over the next quarter and how we're going to achieve those goals. So, again, it depends who your advisors are, who your accountants are. Obviously, we're quite forward-thinking and we want to help clients looking into the future. So I would say that, advisors that have got that sort of growth mindset and want to think forward, they're the ones that are going to be important.
Amazing. I think that about covers what we wanted to talk about today. We like to keep these videos reasonably detailed, but also not overwhelmingly long. I don't think anyone, not even Martin, wants to talk about this for hours. But I hope you found this useful. If you have any questions or approaching a fundraising round, you can contact us via our website, which details are below. It's either that side or that side. I don't know which way. But otherwise, thank you very much for watching, and thank you, Martin, for joining me.
No problem.
And subscribe for more like this.